Good afternoon, everyone. It's T3 Live Editor-in-Chief John Darsie back here to bring you the daily recap. Scott back from his travels, so it's good to have him back in front of the screen and giving some of his thoughts. I know it helps people out a lot, but it's my turn to jump back in and sort of give you a synopsis of what we saw today and what we saw this week. And again, today, I think we got sort of that choppy action that we've continued to see, but we also got sort of the action I think that everyone expected after yesterday's big down move, in that we did get a little bit of a bounce, given the carnage that we saw yesterday, the magnitude of the sell-off early in today's session. But I think most people that got long for a trade early in the day today had no intention of holding any stocks over the weekend, given some of the downside that we've seen in U.S. markets and then some of the downside in response to that we've seen in foreign markets. And overall, you can just take a look at the spiders right here. And on the daily chart, you can see it. You can see that we gapped down this morning, but then rallied up to fill that gap in some really powerful moves. You saw a lot of stocks go from red to green there, but then that rally just petered out in the afternoon. As like I said, it doesn't seem like a lot of people are really keen on taking longs into the weekend. And let me look at a 5-minute chart, for example, or maybe I'll go to something like a 15-minute, just give you a better look. As you can see in the morning, a pretty decent sized gap down as world markets were lower, and we just followed through on yesterday's weakness as we closed basically on the lows yesterday. Came and filled that gap, but then starting around 11:30 or around 11 o'clock, we just continued to bleed lower and finish on basically the lows of the day on the S&P. So all in all, it doesn't exactly leave you with a great taste in your mouth going into the weekend. It looked like maybe we could bounce a little bit, but the fact that that rally didn't stick is definitely just another bearish sign, another feather in the cap of the bears who were, for the first time, actually getting some downside traction and getting things to hold. You look at the spiders, and I've talked about this many times over the last week or so, and you'll say, oh, there's a correction coming, the correction's on the way, the correction is just beginning. But when you really look at things, the correction's been underway for a long time. I mean, you take a look at the chart of the Qs, for example, people talking about, oh, this could be the start of a big pullback. There already has been a big pullback. From the beginning of March, the Qs have been in a steady decline, yet they've accelerated to the downside a little bit with some really ugly bars here last Friday and then yesterday. But this thing, the Qs isn't that far away from its 200-day moving average. That doesn't mean that I don't think it could head lower, but at the same time, people are now starting to look for shorts. I think on that 2-day bounce that we saw this week, that was definitely a more compelling area if you had conviction to the short side to look for shorts. And that's what I talked about in a couple of the morning notes that I did while Scott was gone. In a couple of the videos that I did while Scott was gone, I talked about how I didn't really believe in that bounce. I thought the jury was still out on whether or not it was going to stick. I thought the market still had a lot left to prove, and a lot of these high beta tech stocks in particular had a lot left to prove. And the proof was in the pudding on Thursday with that huge engulfing bar. And again, some things are holding up okay, but when things start to really get to the point where there's panic and there's fear in the market, sometimes the baby gets thrown out with the bathwater. So you're seeing a lot fewer stocks hold up really well right now, and I think that's why traders are choosing to definitely take more of a cautious approach. I didn't really see anybody on the virtual trading floor with any equity positions through the weekend, either long or short. On the short side, it's hard to be short into the weekend given the magnitude of yesterday's sell-off and then today's follow-through to the downside, but it's also hard to jump in long considering some of the damage that we've seen and some of the panic, like I talked about, that's starting to set in a little bit. But all in all, let's look at a few sectors. IBB, this was another one that people had been looking to yesterday. It was one of the first ones to engulf the previous day's gains. They quoted Scott on CNBC Worldwide blog about this, about how when a leading sector like the IBB, or a sector that was leading for a long time, engulfs a big rally in the first hour of the session like happened yesterday, that's a telltale sign that things want to go lower. And we got downside the rest of the day yesterday, and then it looked like we wanted to go green today, but it staged a really hard reversal to close below its 200-day moving average. So definitely a complexion changing in a big way in the IBB. Look at something like Gilead. This was a poster child for the manic action that we saw today in the biotechs. You saw a gap down this morning. I'll go to the 15-minute chart again to give you a look at what happened intraday. You saw a gap down this morning, but it was quickly filled in that first 15-minute bar, a little bit of a 2-bar, 30-minute stagnation, and then it continued to the upside. Looked like it was headed for really impressive gains after a gap down, which would have been a huge day to take notice, but instead topped out and just faded the rest of the afternoon and finished near flat. So not a very convincing move, obviously, there for Gilead. And I talked about this in the virtual trading floor a little bit, is that if you look fundamentally at some of these, especially the big cap biotech names, a lot of people are talking about how they're significantly undervalued from a fundamental perspective. I know at T3 we focus more on technicals, and I believe technicals paint a clearer picture of what's going on, obviously, with supply and demand, but I think you could increasingly see that type of rhetoric from analysts and stuff like that, and I think there's going to be some interest in stocks like Gilead down at these lower levels. Yes, it did break his 200-day moving average, but sometimes things get to attractive enough levels that institutions look to get involved, and it did hold a support level you can see here back from last October, beginning of November. So something to take note of there. Obviously didn't have great upside follow-through after the initial strength today, but I think at least today's action shows you that it's found its footing a little bit. But we'll wait and see. Maybe you can get a chance to buy it lower as well. Celgene, another one that looked like it was going to be impressive today. Big negative to positive reversal, but then closed back down to finish with losses and put in definitely not the most convincing candlestick in the world, and looks like it might want to break lower as well. You look at something like BIIB. BIIB, another one went positive, but then reversed really hard and now closed down around here at the 200-day moving average. So the biotech sector not looking too healthy at all right now. I think it's getting closer to levels where I think people might want to start looking to put money to work, because this is another sector that this one isn't starting to break down. The biotechs have been breaking down for a month and a half now, and they've had some really deep corrections. So to say that, maybe if you're expecting some sort of monstrous 30% 1987 style crash, which I don't think is going to happen, and I think it's somewhat irresponsible for people like Mark Faber and other people in the media coming out and saying they expect maybe even a worse crash than we saw in 1987. I think that's just ridiculous. I think it's somewhere in between people that are extremely bullish looking to buy the dip and the people who are looking for these monster type crashes. I think you'll continue to get choppy action with sort of short-term snapback moves in both directions when you get to extreme oversold and overbought levels. The put-call ratio at extreme levels has also served as a good indicator recently. And just looking at a few individual tech names, you look at Netflix. This is another one that looked like it might want to bounce from the gap down this morning, but then reverse back lower and close below the 200-day moving average. Look like its complexion is continuing to weaken amid all the new competition from potentially Apple and Amazon and all that type of stuff that's been hitting the news in the last few weeks. So that one's definitely looking weaker. We'll see if it can reclaim that 200-day moving average within the next few sessions. And then Facebook, we've talked about how this one is one that traders are definitely looking to on dips to be one of the market leaders. And during the 2-day bounce, that definitely remained the case, as you saw a really impressive 2-day bounce on Facebook. But on Thursday, you got that huge engulfing bar that tells you it also might want to head lower, despite the fact that it is a market leader and one of the strongest stocks out there. But then again, this morning, I think some people look to get involved with it long on the gap down, and they got some really nice early returns. But if they tried to stick with it and hold it for more of a swing type move, they got punished because, like a lot of other stocks today, it faded off its highs of the day, and pretty significantly off of its highs of the day after some of that early strength. So another red flag type sign there that this bounce maybe isn't necessarily going to be as ferocious as some people would have liked. And you look through the rest of social media, Twitter just continues to bleed lower. This is another one that I was just talking to some people today. I'm like, at what point does Twitter become a buy? I mean, look how far this thing's come down. It had this big earnings gap down, filled some of that gap, but since the beginning of February, this was basically a $70 stock almost beginning of February. Now we're down here at $40. There's still excitement in the social media sector, and there's still stocks with ridiculous valuations in social media. If WhatsApp can sell itself for $19 billion, Twitter, I think, can bounce a little bit from, you'd think, from these $40 levels, but who knows? Maybe it's one of the ones that's left out of the party in the long-term social media game, but who knows? But if it breaks this key pivot support, who knows where Twitter could head down to? You look at something like Yelp, this thing's been absolutely taken to the woodshed. This was a $100+ stock. Now we're down here at the $60 level. These, like I said, these corrections aren't starting. These have been monster corrections that have already happened. If you're paying too much attention to the S&P, you haven't seen all this damage that we've seen under the hood. I think most people that are on the T3 Live virtual trading floor and in the T3 Live community have been watching videos, and just I think they're sophisticated enough to see this on their own. But just huge corrections here, and that's why I think people are leaning short right now. Things feel heavy and feel weak, but it's hard to short some of these things given how far they've already come down. And even you look at something like Zillow, this is one that hadn't pulled off a significant amount prior to today, and today sort of joined the bearish party and broke down pretty hard after holding up decently in the morning. So not a lot of places to hide right now. There are a few stocks out there that are holding up decently well. I mean, you talk about the one I've been talking about all week, FSLR, a little bit of weakness today, but still just coming into the bottom end of this bull flag type pattern. So all in all, that's pretty constructive. OVTI, another one I've talked about ad nauseum this week, put in a little bit of a doji candlestick. You can't really blame it. It sort of followed the action of the broader market today, and it was a Friday, so sometimes volume and stuff isn't quite there, but this is another one that's holding up pretty well. You could look at a name like GTAT. GTAT, a little bit of it actually finished around flat today, so it showed relative strength. It was weak for a little while there, but then bounced off of its lows and off of its highs to form that little doji candlestick, but it's one still holding in these upper levels and above this little gap that was formed around early March. So GTAT, one that's looking pretty good to me as well. And just running through a couple other tech stocks. I know solar, I believe I heard on a loudspeaker on the trading floor that TSL, Trina Solar, actually just released guidance after the close, and it's a warning. You know what? Let's take a look at that. But Solar City's come back into its 200-day moving average. Looked like it might want to break down below that. It was a $90 stock in late February. Now looking like it's going to touch 50. But let's look at TSL. I heard that news about that warning after the close. We'll go to 24-hour. 1142 is where it's trading. Not really printing after hours, I guess. So down a little bit. But that'll be something to watch to see how these solar stocks hold up during earnings season. Another thing worth paying attention to today was the financials. Alcoa was traditionally thought of as the company that started off earnings season because it was a Dow stock. It's an aluminum company. But Alcoa has sort of fallen more into the periphery, and it was removed from the Dow. So I think people really look to these first bank earnings reports as the start of earnings season. That's what we got this morning with Wells Fargo and JP Morgan. As you can tell from what we saw in the XLF today, those reports were not received very well by the street. JP Morgan's in particular was not received well at all. It tried to bounce a little bit after a huge gap down below its 200-day moving average, but like a lot of stocks, got smacked down and finished well off its highs of the day. And then Wells Fargo is a different story. Wells Fargo gapped down and headed lower in the first 15 minutes. This is an interesting, talk about intraday type setups. Go to the 15-minute. Get off my 24-hour. You can see, well, if you look on the 5-minute chart, it's clear. You can see the king and queen candlestick formation there. Gap down was really weak in that first 5-minute bar, but then when it engulfed that 5-minute bar in the next 5 minutes, that tells you that it wants to bounce, and that's what it did. It continued higher and showed relative strength to finish with gains today. And just overall, this one is the clear cream of the crop, best in breed among the banks. And it's one that pays a nice dividend. So if you're looking to put money to work long term, I think Wells Fargo is definitely your best bet in my opinion. And that'll about do it. Like I said, there's individually, I think most stocks followed the trend of the market today where they were strong early and bounced as I think some traders looked for a day trade type setup from oversold levels. But then there wasn't any commitment to that, as I think most people who rented those positions in the morning returned them to the bike shop in the afternoon and didn't want to have any long positions heading into the weekend when we could get some follow through to the downside, in response in Europe, in Asia, and then who knows what could happen with our futures on Monday morning. Some people are talking about how this correction is coming despite the fact there's no real major news. There's been no real major trigger that's led to this really extreme selling that we've seen. And there's an old adage that they say bottoms are extremely loud. I know when people were looking for bottoms in 2008, 2009, a bottom happens, you sort of know when a bottom happens because it's extremely loud. There's tons of fear, and you see a big capitulation, type candlestick form. But tops are almost the opposite in a lot of ways. They're really quiet. They don't happen because of a geopolitical crisis in the Middle East, or because Russia annexed a little piece of land in the Ukraine, or because of some debt ceiling issue or fiscal cliff. It's not because of some headline that the media prints. Tops happen because institutions, the big players in the market, decide that it's time to start unloading and unwinding their positions a little bit. And that's what we're seeing right now, is that this top wasn't a loud top. There wasn't some huge crash after we gapped up 1% on some big positive news, or there wasn't some big crisis that hit that led to a big sell-off. This top has just been a little bit quiet, and who knows if it's going to be a permanent top or at least a swing top over a multi-month or multi-year basis. But it definitely, has the makings of something that looks like we could head lower. And given the harsh action we saw last Friday and the harsh sell-off we saw on Thursday, I think that's definitely the mode that traders are in. Even traders that have been extremely bullish for the last several years, I think they are noting that the market does feel significantly heavy right now. That doesn't mean that traders aren't going to look for select opportunities to play short-term long setups and also short-term short setups, but on a swing basis, I think people are more in that mode of looking to short bounces right now. So we'll look to those weak sectors, the weak stocks in the weak sectors, to see if we get bounces to short. And I think it'll just be a two-way sort of dance right now while traders try to figure out on a swing basis what the next most prudent move is. But this has been John Darsie here for your daily recap. Scott and Brittany will be back in here tomorrow or Monday morning for the morning call. Have a good weekend.